Hello traders, today we want to discuss how to forecast the corrective phase like a pro. How to forecast the corrective phase like a pro. Alright, before we continue, I want to clarify with new traders what is an Elliott wave cycle. The Elliott wave cycle is formed of the multi-wave and the corrective phase. And the multi-wave is formed of the first, second, third, fourth, and the fifth wave. So from the beginning of the first wave up to the end of the fifth wave, this is what we call the multi-wave. And then after the end of the trend, the end of the multi-wave, we have the corrective phase. So if you are an Elliott wave trader, you have counted first wave, second wave, third wave, fourth wave, and the fifth wave. At the end of the fifth wave, you are expecting a correction to begin. Now the question is how to forecast the corrective phase like a pro. Most importantly, how to forecast the end of the corrective phase like a pro. So after we have identified the multi-wave and the correction has begun, how can we forecast the end of the corrective phase? All right, the corrective phase is the correction of the multi-wave. So the multi-wave will be corrected by the corrective phase. All right, the Elliott wave cycle is like this, always multi-wave and corrective phase. How do we forecast the end of the corrective phase? All right, let's get started. All right, first thing first. All right, which I always do when I'm talking about wave forecast, Elliott wave forecast, or market prediction. I need to clarify with traders that when we are talking about a wave forecast, Elliott wave forecast, market prediction, this is not an exact science, all right? This is just an expectation. So with the Elliott wave principle, with the Elliott wave pattern, we can forecast the financial market, but it is an expectation. The market does not have to fulfill our expectation. So if you are watching this video and it's the first time you are watching a video about the market forecast, understand that what we are about to discuss here, the forecast that we are making is an expectation. It does not mean that this is exactly what the price will do. One more thing I need to say to traders, when we are talking about Elliott wave analysis, the wave analysis is dynamic, one step at a time. So with the information that we have today, we can forecast what is likely to take place. All right, but you need to understand that it is an expectation. All right, if the price moves in a different way than we are expecting, we will re-examine our waveform. This is the best approach, so you may avoid all right, trading mistakes or Elliott wave analysis mistakes. All right, but on the other hand, as we are expecting, we are forecasting the end of the end of the corrective wave. If the market fulfilled our expectation, then we have an edge. We are expecting that the corrective phase will end at a specific price level. If it ends exactly there, we have an edge. We have an edge. We can profit from it. All right. So this is very important to understand that before I start this. Forecast. Okay. So how do we forecast the end of the corrective wave? We use the first and the second wave. All right, the first and the second wave will help us to forecast the end of the multi-wave. Let me explain myself. I recorded a video before about how to forecast the market like a pro. I hope that's the correct title, if my recollection is correct. So if we have, for instance, I explained this before, how to forecast the market using the first wave. Check it out at 24 Elliott Waves YouTube channel, how to forecast the market using the first Elliott wave by 24 Elliott Wave YouTube channel. All right, so we use the internal wave of the first wave, all right, to forecast the market. But when we are talking about the multi-wave, we say it's formed on 5 wave, first wave to the 5th wave. All right, so with the first and the second wave of the multi-wave, we can have a bit of idea how far, all right, the corrective phase will go down, all right, after a bullish trend, all right. So we have here first wave, second wave, all right. So we use Fibonacci retracement apply to the first wave. So we want to see how far the second wave went down. So if we have a first bullish wave, how far the second wave went down. If the second wave went down 50%, all right, we will expect the correction to end at the 50% Fibonacci retracement level of the multi-wave. If the second wave ends at 61.8%, we will expect the corrective phase to end at 61.8% Fibonacci retracement of the multi-wave. If the second wave ends at 78% Fibonacci retracement level of the first wave, we will expect the correction to end at 78% Fibonacci retracement of the multi-wave. So on my chart here, I have the USD card, all right, the USD card. A currency pair that I've been analyzing using the Elliott wave lately. The last video that I posted regarding this currency pair, the title of that video, let me check it out, my friend. The title of that video was Market Forecast Using Zigzag Pattern. Okay, market forecast using zigzag pattern by 2-4 Elliott wave. That's the last video that I posted about the USD card lately, all right? In that video, I was telling traders that we are expecting that a zigzag pattern to be formed, and we are expecting the USD card to go up to the 50% Fibonacci retracement level of this move from here down to this level here. And if you reach the sweet spot zone, which is the zone between the 50% and the 61.8% Fibonacci retracement level of the move from here to here, they has a high chance to go down all the way to the zone between 138.2% and 161.8% Fibonacci extensions of the move from here down to this level here. Now, if you do not understand what I just said, you need to watch the video that I titled, okay, Market Forecast Using Zigzag Pattern by 2-4 Elliott Waves YouTube channel. All right. So we want it to go up to this point and then to go down here. But now we want to forecast where the corrective phase will end. So on this chart, we have a multi-wave. So we have consolidation, first wave, second wave, third wave, fourth wave, and a fifth wave. So from here, hold on please traders. From here, I'm going to change the color into orange. Up to this point. This is what we are calling up to. From here to here, we have first wave, second wave, third wave, fourth wave, fifth wave. This is what we call the motive wave. Now, we want to know, now we believe that a correction is underway, and that correction is likely to be a zigzag pattern. Goes up to this point and then come down here. That remains to be seen. The forecast is an expectation. All right? But we want to use another tool, which is the second wave of the multi-wave. How far the second wave went down in relation to the first wave right here. It went down 78% Fibonacci retracement level. All right, so it went down. The second wave retraces the first wave 78% of the first wave. Because the second wave of the multi-wave has retraced the first wave of the multi-wave up to the 78% Fibonacci retracement level. According to the Elliott wave principle, all right, we will expect the corrective phase to end at 78% Fibonacci retracement of the multi-wave from here to here. So now we will apply the Fibonacci retracement to the multi-wave from here all the way up here. We will expect the correction that is underway now to come down to which level? 78% Fibonacci retracement level right here. This is, you can see the 78% here. This is 78%. So we are expecting the corrective phase that is underway to end right here at the level of 11355. 11355. This is how one can forecast the end of the corrective phase using the retracement of the second wave in relation to the first wave of the motive wave. It is very simple. It's also powerful. I need to remind traders that in this particular case, all right, that 78% Fibonacci retracement of the multi-wave is equal to the 161.8% Fibonacci extension of the move from here down to this level here. Let me explain myself again. The 78% Fibonacci retracement of the multi-wave, which is at 11355, it is also equal, in this case, it's not always, but in this case, it is equal to the 161.8% Fibonacci extension of the move from here down to this level here, in this case. All right? Because in order to forecast the C wave of the zigzag pattern, A, B, C, the C wave of the zigzag pattern, we are expecting a C wave to end between the 138.2% and the 161.8% Fibonacci extension level of the A part of the zigzag pattern. But in this case, using the retracement of the second wave in relation to the first wave of the multi-wave, the 78%, because the second wave has retraced the first wave at 78%, we will expect the correction to end at 78% Fibonacci retracement of the multi-wave. But in this case, the end of the C wave of the zigzag pattern that we are expecting is also equal to the 78% Fibonacci retracement level of the multi-wave. So this level of 11355, we need to monitor that level. So we have now forecast where the corrective phase is likely to end. So for the USD card, we are expecting it to continue to go up to this point here, and then slowly to go down into the zone of 11864 and to end at 11355. As always, I need to mention one more time, when it comes to Elliott wave forecast, this is not an exact sign. This is an expectation. This is a guide that will help us to have an edge, which means if the price is doing exactly what we are expecting, we have an edge. All right. So one more thing I need to clarify to traders. Probably you have been trading this Friday that is gone. Friday. Have you paid attention to the economy news? This is about the Elliott wave analysis mistakes. All right, so last Friday was why we had which Friday? Okay, the Friday, the 7th of October is the no-farm day. So we say to traders, it's so important that between the 1st and the 8th of each month is quite challenging for day and swing traders. So if, for instance, last week you did forget this, it means that you are not catching up very fast. You need to catch up, okay? You need to catch up. Be aware, between the 1st to the 8th, it's quite challenging for day and swing trading. And between the 15th to the 20th of each month, it's quite challenging for day and swing trading. And last Friday is a no-farm economy news day. And we see that the news was released, a high-impact economy news was released. Though we were expecting the USD card to go down, look what's happened. The price went down big time. But look, it quickly recovered and started going up. All right? This is economy news changing the dynamics of the market. So for a swing trader who is trading this, all right, if you do not have a strong stop loss, you'll be taken out first, because of those high-impact economy news, because of the market environment that is quite challenging between the 1st and the 8th. going back to the main topic today, which is how to forecast, okay, the corrective phase like a pro. We know that we can use the first and the second wave. We can use the internal waves of the first wave. So here on this monthly chart, we count 1, 2, 3, 4, 5 waves. This is a multi-wave. Now we are expecting a correction in the form of zigzag, down, up, and down. But on the monthly chart, okay, a cycle is underway. A cycle is about to finish. But the multi-wave of that cycle is completed. Remember this. A cycle on a monthly chart will be a mini cycle on a higher time frame. Now, I need to say this again because it's so important. A cycle on a lower degree is a mini cycle of a higher degree, a cycle. So, though we see 1, 2, 3, 4, 5 to this point, this move from here to here, on the higher degree, this move from here to here will be one wave. So on a higher degree, this will be first wave. First wave. And the corrective phase that we are forecasting now, which we are expecting to be a zigzag 1, 2, 3, that if it's completed, right here, that corrective phase on the monthly chart will become a second wave of a bigger cycle. Now, now, do not forget everything that we are discussing on this channel, all right? If the second wave of a bigger cycle of a higher degree, in this case completed right here, it does not mean that we'll definitely have the third Elliott wave. A correction can be a complex correction. But if, and also, which I said before, there won't be any third Elliott wave if the fundamentals are not solid, if the market environment is not viable. Though the move from here to here is the first wave of a higher degree. The move from here, 1, 2, 3, if it's completed here, will be the second wave of a higher degree. And then we will expect the third Elliott wave of a higher degree. But there won't be any third Elliott wave. Just remember, whenever you hear the word third Elliott wave and you identify the beginning of the third Elliott wave, check the fundamental. There won't be any third Elliott wave if the fundamentals are not solid and the market environment is not viable. You will instead have what we call a complex correction. So a trend, you may see that, you may think that this is the third Elliott wave underway, but you won't go far. That will form what we call the X. So that will be a zigzag plus X, and we will see another correction, and that will form a complex correction. Now you see what we are talking about, that the Elliott wave count is dynamic, the Elliott wave analysis is dynamic. With the information that we have, we go from there. So when the price reaches this level, we will be checking the fundamental, and we'll be expecting a third Elliott wave of a higher degree to be underway. But if the fundamentals are not solid, the price may start going down from here and then stop somewhere here, and then form another zigzag, or we may see a consolidation, forming what we call a complex correction. Whenever you see a corrective wave that is completed, remember that a correction can be a complex correction. A double zigzag or a triple zigzag can be formed, or a combination of a zigzag and a flat correction may be formed, making the correction a complex correction. That's why I say to trade one step at a time without violating the market pattern, without ignoring anything, without assuming anything. So in order to forecast the corrective phase on a particular time frame, because I'm now on the monthly chart, a multi-wave is completed on a monthly chart, a corrective wave is under corrective phase is underway. We can focus on this monthly chart, the end of the corrective phase, by using a retracement of the second wave of the multi-wave. I don't want this video to be too long because now I believe traders are maturing. All right, there are videos we recorded before, there are things we have discussed before, and I'm going one step at a time because I want you to understand it so you also can be able, to use the Elliott wave like a pro, and most importantly, not only for the excitement, so you can make profitable decisions. All right? We are following the price, and we must trade the price. All right? The economy news and the fundamental can change the dynamics of the Elliott wave analysis, one step at a time. All right? If you have any question or suggestion, put in the comment section. And in due course, I will be busy recording another video to answer your specific question. We are the TSTWSYS008 traders talking about how to forecast the corrective phase like a pro. Happy trading to you all and speak to you soon.